So this is one of a series of regular webinars which we're hosting in the run-up to the Urban Living Festival, which is taking place in London towards the end of November. We started them off fortnightly, but there are a few bonus sessions that have been dropped in. And as I say, they're leading up to this event, which is a new event we're very excited about. It's going to be looking at all kinds of hospitality and real estate asset classes, how they're converging, and how the industry is evolving in general. Next, please, Justin. So just a little bit of housekeeping here. As I said earlier, everybody is auto-muted. But if you do want to ask us any questions as we're going along in the session, you can use the chat, which you'll see on the bottom of your toolbar on your Zoom screen. We'll be talking for 40 to 45 minutes or so with our panelists, and then we'll go on to the Q&A at the end. Next, please, Justin. So my name is George Searle. I'm Editor-in-Chief at International Hospitality Media. We are publishers and event organisers across various sectors of the hospitality industry. And joining me today, we have an august panel, and I'd just like to ask them all to briefly introduce themselves. So if we go clockwise, can we start with you, Andrew, please?
Sure, thanks, George. So my name's Andrew Harrington. My company is AHV Associates, been around 20 odd years. We do M&A and corporate finance advisory, buying, selling, raising money, privately owned businesses, mostly in hospitality and all around Europe.
Thank you. Mariapia, would you like to go next?
Thank you, George, and good afternoon, everybody. My name is Mariapia Intini. I am a director at citizenM Hotels, focusing on development and investment in selected cities in Europe. citizenM is an integrated investor, developer, and operator of hotels across the world. We are backed by 3 shareholders, specifically APG, Dutch pension fund, GAC, Sovereign Wealth Fund of Singapore, and the family office KRC Capital of our founder. We invest preferably 100% acquisitions, but we are open to joint ventures, ground leases, and minority stakes with a management agreement. At the moment, 20 hotels across the Europe, Asia, and North America, and over 20 under development. Thank you.
Great, thank you. Tim.
Thank you. Good afternoon, everyone. Tim Helliwell. With Barclays Bank, within the hospitality and leisure team. I've covered the hospitality and leisure sector for crikey nearly 20 years now, with a focus on hotels. I'm based within our investment bank, so cover all aspects from equity and debt capital markets, conventional bank debt, and through that M&A finance, development finance. Yeah, it's delighted to join you today.
Thanks, Tim. And last but not least, Merzak.
Thanks, George, and good afternoon, everyone. I'm a Merzak Kaddour, Investment Director for edyn Group. We are squarely in the extended stay segment of the hospitality industry. edyn owns, develops, and operates brands such as the Lock brand and a well-known portfolio, which is the Seiko Service Apartment portfolio. We are wholly owned by Brookfield Asset Management and have been for the last 2.5 years. Previous to that, we were owned by Oaktree Capital Market. And my remit extends to investment, acquisition, underwriting, and funding, both on the equity and the debt side.
Great, thanks, Merzak. Justin, could you just roll on to the next slide, please? Okay, so to give this discussion a little bit of backdrop, I won't read all these out in full, Starting from the top, there's been some quite alarming figures about the levels of rent that commercial landlords have been paying in the last couple of months. I haven't seen figures specifically for the hotel industry, but I'd be interested to see what they are. The UK government has announced changes to insolvency laws, which will make life easier for some operators. In the US, Harry Spirides of Spirides Hospitality Finances, the only hotel development loans being made at the moment are the ones with developers who have the very best credit ratings and the strongest balance sheets, with premium flags in prime locations and a low loan-to-value, high debt service coverage ratio, and solid personal guarantees. So, you know, not the easiest of tick lists to fulfill, but that's where we are at this very moment. CoStar says distressed hotel sales resulting from the pandemic could exceed the volume after the 2008 financial crisis, but these transactions may still be months away as buyers and sellers try to align price expectations. Next, please, Justin. But there are causes for optimism. Things are still happening. Last week, apartment rental company Sonder raised quite a chunky Series E round, which was led by existing and new investors. Certain segments of the industry have outperformed others and have done especially well, particularly apart hotels, extended stay hotels. Soho House secured a large equity injection led by Ron Burkle. Obviously, it's had a hard time, but the investment was made at the same valuation as before the pandemic. And Puma Property Finances has completed a development facility for a hotel in Buckinghamshire. Okay, so I'd like to kick off our discussion. Not quite sure whose phone is appearing on the screen now, but we'll kick off by asking each of you in turn, in general, how have attitudes to lending and investment changed as a result of the pandemic? Andrew, would you like to kick off?
Sure, George. Well, obviously, you know, when something like this hits, there's a sort of, oh my God, sort of pause, right? Just to sort of take stock. And I mean, a lot of the transactions that were announced in the March-April period were transactions that had already effectively closed. It was a final close and they had to go ahead, etc. So there's an element of pause, but I actually, highly controversial statement, but I believe it to be true. I actually do not think that lending and investment will be fundamentally changed because of this. Right? You've got masses of money out there, like gazillions. You've got banks with twice the equity capital they had 12 years ago. You've got dry powder 50% more than 12 years ago, i.e. post-2008 in the professional investor world. You've got interest rates at rock bottom. In the hospitality sector, you're going to get some that go bust, probably not very many, and probably ones that were marginal in any case. You're going to get a delay in development. So the ones that are left, right, are going to be more efficient because a lot of the stuff that they have to do actually makes them more efficient. They're going to have less competition. And you've got interest rates at rock bottom, huge amounts of capital. You know, so there's actually a pretty decent investment story for hospitality. But the direct answer to your question is shock horror, everybody stops. Now, and certainly for the last 4 weeks or so, there's a real sort of desire, generally speaking, to look for investments to make because there's so much dry powder. And I really think there's a very positive investment case for hospitality, which is different from what it was 4 months ago, but it's still very positive. So bit of a nuanced answer, but those are my thoughts on that.
Thanks. Tim, as a representative of a bank, what would your answer be?
Well, I think when you talk about attitude, I thought the first attitude that came out was one of kind of compassion and support, really. I felt that the banking sector to be fair, supported by the regulator, was absolutely committed to doing the right thing. And certainly any business that was trading well pre-COVID, I believe, was supported by their bank. It's quite interesting how, of course, this is something that we've never experienced before. I've never experienced before. And, you know, basically you had to rewrite the rules as you were going, and time seemed to slow down, but yet speed up. And what I mean by that is that a week of COVID was probably the equivalent of what was 2 months in normal world, because the world was changing so quickly, and clients had to very quickly get up to speed in terms of, you know, what did their business look like now, or what was their cash burn, etc., and more challenging, what could it look like over the course of the next 12 to 18 months, and then more importantly, what do they need from their banks? And for the banks, it was, you know, some relatively straightforward gimmies in terms of changing, you know, covenants, waiving covenants, or putting amended covenants in place, potential extending of lines, looking at government schemes, we can possibly talk about that later, and potentially looking at new money over and above government schemes as well. So I think, you know, it's fair to say that, you know, from the start of March through until probably maybe a couple of weeks ago, an absolutely crazy period, but a really positive one, I would view. I think the attitude now, and to Andrew's point, is, of course, clients in the hospitality and leisure sector don't really want to talk to their banks now. They should have done it. They're now utterly and rightly focused on opening their business. I think the next question for us as lenders will be as well, you know, how is that opening going? And I think it's also fair to say, I have to say this as a banker, but, you know, it's going to be more pragmatic now, because, you know, how are those projections that were put together, how are they starting to unfold? What is the business looking like? Frankly, there'll be more time to assess how business models are working now as the opening periods progress. So I think, you know, compassion and support in the first 3 months. I think you'll start to see the banking sector becoming, frankly, more pragmatic now as businesses start to come out of hibernation, and I think you will see again possible more access to government loan schemes. You're probably going to see more opportunities. We're starting to see some opportunities to come through as well. It's certainly not all just about existing clients. So I guess to answer your question, compassion and support first. Now, as businesses are starting to open, moving more towards pragmatic, and frankly, a little bit more towards business as usual.
Great, thanks, Tim. Mariapia, how have you found your relationships with your lenders and investors to be over this period, and how is the outlook going forward?
At citizenM, we believe in transparency. So we have kept a very regular and transparent relationship with our lenders, with our 3 lenders. We have shared with them the liquidity situation, our liquidity forecast, and we've also informed them about the support coming from our shareholders via written documents, and then we've I have to say that we've asked all we shared, as I was saying before, we've been quite transparent in exchange of some waivers. Waivers in terms of financial covenant ratios, which we provide every 3 months. So the idea is, okay, we still provide these ratios, but they cannot become a reason for default. It's fair to say that this conversation has been quite positive with our lenders, and that's because of the fact that they've been with us for a very long time. So one of them since inception, so since the first opening in 2008, and the other 2 since 2011. So they know the way we operate, they know the strength of our shareholders, and therefore they have agreed to stay by our side, also in view of what is the plan, the strong business plan that we put forward. So overall, I would say we've been lucky. We've been lucky just because of history and because of the strength of the shareholders.
Do you think the fact that you are, in many cases, an owner-operator has been to your advantage? There's one less link in the chain, if you like.
Yeah, in fact, that's another good point, George, because I think the banks also appreciate the fact that we are very cautious. Our loan-to-value ratio doesn't go over 50% in any of the assets that we own. So this actually adds up to all the other factors of comfort that I was mentioning before, and therefore, yes, like knowing that we have skin in the game, so-called, I guess helps a lot.
Great, thanks. And Merzak, at edyn, how have you found dealings with your lenders and investors over the last few months?
It's interesting, George. I mean, listening to Mariapia and Tim and Andrew, it's the quickest answer to say is that they have been terrific. They've been terrific mainly because if you look at the situation BC and AC before COVID and after COVID, before COVID, and Tim mentioned it earlier, if the business was fundamentally sound, if the business plan, to Mariapia's point, transparency with the lender, if the lender buys into the 5-year plan or however number of years, and you have a good offer and a good proposition, critically a strong management team in place, a management team that maybe has experience of navigating through troubled waters. That's not just the GFC, but other issues maybe that have impacted hospitality in the past. If you have all of that, then in reality, banks will find it difficult to just let go of a borrower or of a connection who ultimately will have the capacity, the know-how and the guile maybe to navigate themselves through this trouble. So before COVID, we felt we had a strong enough business proposition. This year, George, as you know, was supposed to be our year, 7 openings across Europe. And then this thing called COVID turns up. We're still going to end up opening 4 assets with 3 assets next year. And then COVID intervened. And the first thing I did just before the lockdown, I was fortunate or unfortunate enough to catch it 3 weeks before the lockdown, actually. And whilst at home and locking myself in my bedroom, I started ringing our lenders, a lot of them ex-colleagues I worked with. And the value of the relationship with the bank is never more crystallized as during troubled situations. I was a banker myself during the GFC, and I know exactly the conversations I had with good borrowers and bad borrowers. I won't bore you with the details. The first thing I did was to call the lenders and say, listen, this is obviously, I believe we're going to have a lockdown. It's happening in Europe. It's going to come here. We are reworking our cash flows. I'm going to share them with you. We have a strong ownership, strong sponsorship. I looked at the cash burn. We had a massive runway. To Mariapia's point, we don't believe in high leverage for the sake of it at all. Across the estate is a very, very decent level and a reasonable level to allow for refis. I should know because I did the job 15 years ago, and there's no point turning up with something stupid hoping to refi it, even in the good markets. And so the conversation was really, really good. And we managed to have a position with our lenders. And when I say lenders, George, this is another consideration. If you look to expand in Europe like ourselves, you can't end up having 30 relationships. You can't call them relationships. On a development front, for instance, I have 2 relationships, huge, hundreds of millions across 2 relationships only. With the investment side, we have 1 bank, 1 super bank. Now, you might argue that that could be a concentration risk, putting all your eggs in one basket, but we knew that they were a bank that understood the hospitality, that also understood the segment that we're operating within the hospitality, bought into it, and regular dialogue with them. We have monthly catch-ups with the lender, even in the good days. Post-COVID, or during COVID, we started having weekly conversations with them. They liked the business plan. We revised our plans, our 5-yearly forecast, with what we felt was a very, very realistic case, and we gave 2 scenarios. This is our base case, a semi-Armageddon situation that includes a second spike. Heaven forbid, I hope we're not going to touch on that subject during this call. And another one that paints a better picture and what the numbers might look like. And we encouraged the lender to seek advice from their various advisors on the agency and valuation side. And they came back and said, you know what? That's spot on. That's what they're telling us. So it was a realistic business plan. So that boded well, and the conversation was very, very good. We managed to do all of our negotiations within 2 or 3 weeks of lockdown, and that's it. And we started thinking forward, focusing on opening the new assets rather than thinking what COVID has done to us. You touched on it earlier, George. We were fortunate. We were flabbergasted by the level of business that was generated during the lockdown, where most of competitors were shut. We were open and trading at 80% capacity. The 20% that was closed off was deliberate by us. We opened a brand new asset 2 weeks before lockdown at Broken Wharf, and we felt we wouldn't do it justice to let it trade at 30-40% occupancy or 25% occupancy. We'll shut it down. We'll give the team a chance to play around with the asset and finish last few glitches, etc. And we reopen it post-lockdown. That's one shutdown. The second shutdown that we did in Edinburgh, we had 30% occupancy, and we felt it needed a bit of a lick of paint. That opened in 2016. Quite frankly, that was an opportune moment. Other than that, we've been trading throughout the lockdown phase and trading really, really well. One final point, something that amazed me, 4 weeks into the lockdown, we got in weekly updates from our commercial team, and they shared the wonderful news with me that the cancellations were overtaken by new bookings. To surprise you even more, guys, what the new bookings were from 1st of June. And I thought, do they know something we don't know? They were expecting, corporates and leisure were expecting things to ease up from June. You could argue they're almost spot on. This is back in April. So yeah, it's been good negotiations, good conversations with the lenders. And I think it goes back to really what do you mean by strong relationships with the lender? Either you have it or you just say it. And we felt we chose the lenders well.
Yeah, thanks, Merzak. You bring me neatly on to the next point about certain types of hospitality offers which have come out of the recent period looking stronger, and obviously extended stay and apart hotels have managed to stay open. Some have recorded some incredible occupancy. Obviously they've had to shift the mix around a bit, and there's been, you know, catering for key workers and so on. Tim, can you foresee more activity in those sorts of areas as they've proved how resilient they are to this?
Yeah, I mean, very much so. That they have performed well. It has been a sector, and indeed it's a sector that going forward in this new world is one which just in terms of its modus operandi sits well with where we find ourselves. But I'm of the view that the way that the wider industry is responding to this issue in terms of its protocols, you know, in terms of operational protocols, cleanliness protocols, etc., I'm frankly positive around the sector as a whole. Yes, I can see extended stay service departments doing well. We can see that those with perhaps at least in the short term a more narrow service offering will equally do well. But fundamentally, I do have confidence in operators and how they're going to react to the pandemic and where we find ourselves and how they progress. We're starting to see it, you know, both in terms, you know, of the majors and indeed right down to individual operator level. So yeah, I can see that the serviced extended stay market, yeah, it sits well, as does the economy and budget. But in general, I see the sector frankly getting to grips with this now. It's all about consumer confidence, and if they can give the consumer confidence that it's safe to come and stay, then I believe they're going to start coming back.
Yeah, thanks, Tim. On the subject of consumer confidence, we're lucky enough to have two operators here who have very strong and very recognisable brands. Do we think that brands are even more important now when it comes to securing funding and investment than before the pandemic? Andrew, what's your take on that?
Well, I mean, you know, there's two different pots of capital, isn't there? There's debt and equity, right? And debt is going to be concerned about when is consumer confidence coming back, because they're fundamentally risk averse, of course, because it's just debt-like returns. And they're going to feel a lot more comfortable with established, recognized brands, you know, like citizenM and edyn and all the big flags, etc. Lending ratios will come down, etc. Now, on the equity side, I think it's a different story, because equity returns, to calculate equity returns, you discount the value of future cash flows. Now, if you take the view, this is sort of a bit to Tim's point, if you take the view that the whole of travel has changed, the whole of leisure has changed, the trends have been established for the last 30, 40 years, which is consistent growth in travel and leisure, it's all going to go out the window, and we're all going to change the way we operate, then for heaven's sake, don't invest in this sector, right? For the rest of us who think, okay, we've had a big hiccup, actually the perception of risk is a lot greater than actual risk. I mean, even if there's a second spike, that holds, right? And we can go into that if you wish, but the perception of risk is greater than actual risk. You've got these very long-term trends that have been established through thick and thin over many, many years. It is going to come back. It's going to come back maybe in different ways. In the meantime, interest rates have gone down, huge amounts of capital out there. The net present value of cash flows, probably for a hotel, you know, discounted back at a lower interest rate because the level of interest rates have gone up. It's probably not going to be that much different to what it was 3 or 4 months ago. You know, from an equity perspective, I think, you know, certain things will be more favorable than others, but broadly speaking, I think there's equity to support the broad range of hospitality. On the debt side, debt will be particularly sensitive to the level of consumer confidence and brands, etc., etc. So I think you just got to segment the capital market. And if you hate the sector, if you think everything's going to change, if you think we're all going to be working from home and never travel, then don't invest in the sector, for God's sake, right? Thankfully, the majority of us are not like that.
Thanks, Andrew. So Tim, on the debt side, has the importance of a brand been elevated due to the pandemic?
Yeah, I mean, I think if you look back to the GFC, there was an undoubted trend back towards the brands or towards the brands, and for the reasons that we've been talking about in terms of that consistency and, you know, obviously the distribution system, and indeed now, as I mentioned before, that whole point around, you know, this currency of cleanliness that we're all now seeing and talking about to instill that consumer confidence. So I believe there probably is a trend back towards the brands, and of course that's a mega trend in itself as brands start to eat into the independent sector. Having said all that, and certainly if you've been around the sector a while, as frankly many lenders have, you know, the other major trend, of course, is towards micro markets, and certainly, you know, whilst banks may well have a tendency to fund the brands because it's a more structured and easier to comprehend approach. Actually, if you start to get to know the sector and the operators and the names, you become increasingly agnostic, because what you're really looking at, as I've said, is those micro markets, and that's what the thing you've got to be careful of. Yes, you're looking at the location and the management team and what the proposition is, but fundamentally, I think you're agnostic. So I appreciate it's a yes/no answer, but I think yes, you are going to see a tendency towards brands, but that's not to say that lenders are going to ignore the independent, non-branded sector.
Mm-hmm. We touched on this briefly earlier, talking about citizenM. Obviously, there's been, in the sector as a whole, there's been quite a shift towards the split between OpCo and PropCo, and there's been quite a lot of investment into operating platforms recently. Do you think that perhaps the pandemic might be moving towards having some kind of skin in the game, as Mariapia described it, and rather than being purely an operating company? What's your take on that, Tim?
I think citizenM is a great example. That relationship between the OpCo and the PropCo is I believe a very strong one, and it's a linked one. I think if you're looking at more third-party type arrangements, it's probably true to say that, you know, that split will be less marked between a third-party operator and a landlord. I mean, of course, it's been a building trend anyway over a number of years, and you know, for us, operating risk is what we do. We've always, unless you had an investment grade tenant with an FRI lease, I mean, that is a real estate lend. If you're less than investment grade, we've or near to it, we've always taken a view that you've got to be looking far more closely at the operator and the operating agreement, and certainly just to be able to rely on a lease is not at all the right way we believe that you should be approaching it. And certainly what it does mean now, and we've seen a few examples over the course of the last few weeks, is I think there is going to be potentially more control. We've seen it with the talking about the insertion of break clauses, of course, therefore changing the complete dynamic of what a lease looks like. But for the landlords to need to be taking more responsibility in terms of the performance of their tenants, possibly within the context of information that they receive, further benchmarking, things that frankly are out there in the sector. But I do think it's probably likely that you're going to see more of performance leases and frankly a closer relationship between OpCo and PropCo. There's all sorts of details in between, but that's as a headline is what my view would be.
Tim, you mentioned that you are seeing new inquiries. So what kind of levels of activity are we seeing in the hotel debt market at the moment? Are lenders actively looking to lend, and are you getting proposals coming across your desk?
I think the focus has been very much existing relationships and existing clients. There's been a real big focus on finance and finance related issues, and rightly so, over the last 3 to 4 months. I think this is the time where a lot of clients are just focused on opening, and there are certain issues that come out of that where they need wider services from their banks. So I just make the point that it's not all just about finances. There's other stuff that the card acquiring, the cash, all these other things which are a small part of what are the operations of these types of businesses. But there's a lot of more operational style discussions going on. Are there been new discussions? The big challenge, and it's to the investment side as well. It's what does the business look like going forward? Can you look at pre-COVID performance, or is it going to be different? The big issue in terms of new lending and indeed new investment is what are you actually financing or investing into? I would say it's still relatively early. Where we have seen activity, and you put a few of them up on your screen, has been development finance, and it's been more aimed. These are transactions which have been going on pre-COVID, and also very much aimed in the fund market, the debt fund market, real estate fund market. And of course, you're looking at transactions in this case where they're going to be building through the uncertainty of the next 2 to 3 years. They're actually going to open where hopefully the world is a more established place. So conversations have been more operational. My sense is it's going to be difficult for the lending market to open up until they're starting to get a better sense of what business is looking like. Where there has been business, it has been predominantly more in the debt fund market, I would say, and it would appear to be, as a headline, more, from the few bits I've seen, more development linked rather than M&A linked.
Great, thanks, Tim.
George, do you mind if I just add the point to what?
Please do, please do.
Thank you. Because I also believe that traditional lending appetite depends on the type of product that you have, and not just whether you are a service apartment or say a hotel in the economy sector. As we know, both of them have shown quite strong resilience for various reasons, because of less fixed costs and also the fact that they give the customer more a stronger opportunity to effectively be in charge of their own space. So that is the product itself. But I also think that there is an interest from banks in terms of how the product actually can respond to the needs, to the new needs of customers. So, for example, these days it's all about having a contactless experience as much as possible. So being like really in charge as a guest of as much as you can of the experience in the hotel or in the service department. So say if we talk about banks who are experienced about lending to hotels, I'm sure they would also look, and then of course I'm not a banker, I never was, but I have a background as a valuer. So I was talking to them quite a lot. And I remember that, anyway, the type of concept was important. So for example, of course, for me, it's easy to bring an example of citizenM because that's the company I work for. We already have, like now in our hotels, kiosks, which we use for check-in, but we've gone one step further because these days you can also, you can skip the kiosk completely. You can actually check in even before you arrive at the hotel. You never touch the kiosk, you never come across anybody. You have a QR code, you go to your room, you open it, you control by your phone, not even by the iPads, you control the entire room. So you control the entire room, you can order food, you can check out as well, and potentially all of this via your phone, which clearly explains what, I mean, gives credit to what the customer wants. And then of course, like if you have bigger brands, and then also the question that was raised before, the conversation before about bigger brands capturing smaller brands, is for sure, banks understand the strength of independent hotels, boutique hotels, but at the same time, it might be a chance that it might be the case that in this specific period, people are more eager to see certain standards, which most probably across multiple hotels, which most probably are fulfilled, are better explained via brands who clearly have a bit of a competitive advantage when it's about negotiating with independent smaller chains. I have more to add, but I don't want to take too much of of the time.
Thank you, Mariapia. Thanks. Andrew, we have heard quite a lot over the last year about the amount of dry powder that is out there waiting to be deployed. Do you think the pandemic could be the catalyst for that to be used, and how much of it do you think will come in the form of M&A activity, and how much in terms of buying distressed assets a few months down the line?
I don't think there's going to be any distressed assets unless we're all sat at home in 6 months' time, to be absolutely honest. I mean, governments have been hugely supportive. This is not a solvency problem. This is this is just a one-off, etc., etc. So there is a scenario where there'll be a lot of distress. I think that scenario is pretty remote. In March, April, I was getting calls from private equity companies every day asking for top quality assets at a 30% discount. I told them all, they're all smoking dope, because everybody I talk to wants a top quality asset at 30% discount, which means they're not going to get it because A, they're not for sale, and B, if you start out at 30% discount, you'll end up with a 5% premium because so many people want it in the context of lower interest rates. I mean, the key thing, which is really so important here, is that interest rates have fallen by 75 basis points in the last year, right? That means that if you want to get the sort of returns that private equity need, you have to put money to work, right? You have to put money to work. And every situation has a risk profile and a reward profile. I mean, and this is why I think actually at the end of the day, valuations won't change much, because if you want 15% return and interest rates have fallen, your real return's gone up. So that's compensated for by the increased risk, if you see what I mean. So, I don't think there's going to be a significant impact upon valuation across the board. Look back in 6 months' time and have a look. And I think that, to your point, George, I think that there's a lot of private equity companies. I mean, I know there's a lot of private equity companies who are looking to make investments. I think they're more realistic now than they were 3 months ago. They don't expect big discounts. They just want to make sure they understand the risk, right? And don't forget, my final point is that if you start a process today of seeking private equity, you will have a pricing discussion in probably 3 months, right? The world could be very different then. You know, I mean, there's a number of things we're working on where we're going to sort of wait until next week or the week after to start marketing it as the hotels have opened, you know, because then there'll be real data. So I think that it's an absolute opportunity for dry powder to be put to work. There's a lot of people need capital. There's some great businesses out there. And I don't think there's going to be much of an impact upon valuations. And I think there's actually a really good hospitality investment story, limited competition, more efficient operations. You know, if you're still there after this, which the vast majority will be, you're going to be in a good place.
Thanks, Andrew.
George, can I just raise something quickly? So to carry on
Sure.
the point that Andrew has raised. Before I do that, though, can I just go back very, very briefly, though, to the debt situation that both Tim and Mariapia mentioned earlier? I still look at it into two phases, pre-COVID or before COVID and after COVID. Before COVID, it's fair to say, unless somebody tells me otherwise, and I'd love to know how, the lending scene wasn't that great in the UK. Europe was various pockets and various stories in Europe, but in the UK, most of the clearers weren't necessarily in the sector. And what I mean by in the sector, of course, a lot of them have got connections on the books. Not many were lending new to bank. We all know what transactions have occurred since, say, 2013 onwards. We can go further than that, and we know who funded them. Again, you come into the two situations, development finance, development finance. There were very, very few people lending to development finance for all sorts of reasons. Primarily, I believe, because a lot of the good banks of yesteryear lost a lot of the good bankers to the industry. A lot of them retired, a lot of them moved them, joined other industries and what have you. It got to the stage where some of our well-known national banks started handing out cash to debt platforms to ask them to do the underwrite for them. It's just crazy situation. It's not as if we don't have the bankers in this country to do it. So the debt finance was difficult to obtain. Investment finance was plentiful. So a lot of the banks who were playing in hospitality lending were still lending to investment finance. Post-COVID, the situation got worse, but not because it's COVID. It's because previously the people who didn't lend to development finance didn't lend to it. And if we're talking about the debt, let's look at the maturity of the debt. By between 20 and 2024, there's approximately 3.6 trillion of maturing debt. That's huge amount. In 2020 alone, 2022 alone, 771 billion euro. 771, that's a peak year for refi. That's across Europe, of course, according to Standards & Poor's. And that's a big mountain for refi. So I agree with Andrew in terms of we mustn't talk ourselves into the hospitality industry being decimated. I don't think it will be. Whether there'll be a lot of distress or not, that's a matter for debate, and that depends on how much the lenders will stay the course. There is a lot of pressure. There's political pressure on the lenders to stay the course, but at the end of the day, they're not going to be forever supporting businesses who, by December 2019, were not necessarily good businesses, either through the wrong model, operating model, or poor management. And then you have the dry powder. The dry powder is estimated at $2.5 trillion US, PE money, and this is across all times. It's just huge amount of money. This isn't the same challenges we saw in 2008, 2009. Completely different scenario here.
Right.
Sorry, Andrew, you want to say something?
Just one point. Merzak, very interesting. I disagree with you. There was loads of development finance available. It just wasn't coming from the mainstream commercial lenders.
This is it. I was going to say, sorry, I forgot to say, you're right. Not the commercial lenders. I had nothing but development finance, but I used a couple of commercial lenders. The rest were all debt platforms. Immediate reaction, immediate decision. Absolutely. And I've been known, I've been saying it. And whenever I'm asked a question, I point them to all the people who gave me that money.
Exactly.
I've got two huge connections, hundreds of millions from debt platforms. Because for me, I'd prefer a quick no than a protracted yes.
Exactly.
When you need to move quickly. Absolutely. Absolutely. I agree. So I forgot to mention that, which is why I make the point. There wasn't any development finance. COVID has nothing to do with it. That's the reality.
Merzak, you're going to deal with Oak North for one of your London properties. It brings us on actually to a question that's been sent in by a reader from Andrew Dean, and he's asking which groups do you think are being particularly creative in terms of funding and investment? So who are the lenders out there who are
in terms of development? In
Yes.
terms of development finance, look, development
Yes.
finance, to my mind, you mentioned one of them, Oak North were doing development finance. Remember, they were virtually a startup not too long ago, and they started growing their book. And critically, they started growing their capability within the team to be able to move up the food chain. Now, that's critical. That's important, because it's not just any real estate transaction. Doing a hospitality deal, as all of us know, you're focusing on other things. It's not just real estate. You're focusing on the cash flow and the strength of the P&L, et cetera, et cetera. So they started building capability. And I have to say they were very, very good to deal with. Very good to deal with. It's so fortunate and lucky that I happen to know the team very well. And the guy that heads up the team is an ex-colleague. So that opens up doors for you. And also the trust that Mariapia mentioned earlier is when you turn up and sit down with the meeting, they do something novel, Oak North, which is you go and pitch and present to their credit committee at their offices, where you have every single stakeholder sitting in there all the way to the CEO. I find that interesting, because if you get the buy-in all the way to the top, you don't get any surprises further down the line. Another two debt platforms who have been very, very active, and there are several, Cheney Capital on development finance. I mean, when I tell you that on one of our transactions, which is due to open in 3 weeks' time, Tower Bridge Road, they did a deal in 7 weeks. They did a deal in 7 weeks. And nearly a week of that, we happened to be in MIPIM. It wasn't even ideal. We're not even in the office. Then you talk about the likes of, DRC are active in this sector. There are various people you can talk to who actually will be there for you. Kane International, very, very quick, very, very good. And they are somebody who will transact and tell you a quick no or a quick yes straight away. So the difficulty is being in limbo, in our case, when we are, for example, lining up, say, acquisition debt that will flip into development. So I am, or my team are negotiating with the vendor. We want to know if we have the debt or not, rather than, well, let me come back to you. And quite often you get given the runaround, I'm afraid. I've seen things of 11, 15 years ago have not changed that much. But it's still the same message.
Merzak, you pay for that flexibility. I mean,
you do. And I'm going to tell you, Andrew, as a former lender, I used to say, I would be prepared to pay a premium. There isn't a single commercial lender who said to me, if I give you flexibility, would you pay 50, 70 basis points? I'll pay more than that.
But you're not
don't even tell you that.
You're not going to get Cheney Capital lending you 75% loan to cost at 3 or 4%, right? And that's fine. That's absolutely brilliant. And there's a place for them completely. And all the others you mentioned, and a whole load more.
Absolutely, absolutely. And when you get to a situation where your cost of debt is relatively below your cost of equity, and you get someone willing to move very quickly, you deal with them, because that's the only terrain you have to plow. The reality is the commercial lenders, and I spoke to all of them. I was lucky enough to work for 4 commercial lenders. Not one of them will deliver on time. And if they do deliver on time, they give you leverage that doesn't suit your business plan. That's the reality. I'm being honest. That's the reality. It didn't work.
Guys, it's time to go over to some of the questions coming in from our readers. We've got one here from Julian T, who says, in the independent hotel sector, casualties are expected. From a lender's perspective, is there more value to an asset that is open and trading, or more value if it is closed? Tim, would you like to pick that one up?
Well, I think we'll always say that, never close a hotel. And I appreciate that statement within the context of where we find ourselves. But in general, I say never close a hotel. Always operate it through. The destruction of value is normally too extreme to justify just handing the keys back. It should be that in a situation like we now find ourselves, and I appreciate this is new, and I don't know what the individual's background to this question is, but to answer the question, you should never shut a hotel. You should trade it for sale, and as we've heard, there's capital out there. There's capital out there for opportunities. To Andrew's point, all we're seeing right now, I think, is just an expectation gap. There's an expectation gap between buyer and seller. But if you've got an operating hotel, you shouldn't close it.
Yeah. Theo Laverty has asked if the 2.5 trillion of white powder is UK or global. I think he means dry powder there. Presumably that's global.
that is global, and it is dry powder. that is global, yes. Dear me.
Before we move on to wrap up, I'd just like to ask you all in turn, what do you think will be the single biggest effect of the pandemic on the lending and investment landscape? Let's start with you, Andrew, please.
Changing perceptions of risk. I mean, this is a black swan event. People had sort of discounted black swan events, and I think for a period of time, which probably is measured in years rather than months. You saw this after 9/11, right? There was a period of time when everybody, you know, focused on a small, you know, what are the possible catastrophic events that could take place, right? Instead of focusing on the business plan, which is actually much more relevant to the lend or to the investment. The second thing is, just to the point that people were making, there's going to be a fundamental change in the relationship between property owner and operator. And contrary to what most people think, I think the operator is in the driving seat, not the property owner. The operator is, because the property owner just wants reliable income. That's all they want, right? And there's been far too much risk, which has been in the past with the operating company, and the risk is going to be shared much more equally. And the property owner is in a defensive position right now. The operator is in pole position, in my view. And I think that's going to become clear in the next few years.
Thanks, Andrew. Tim, what would be your take?
Well, you had shared this question with us before. My answer, with a look to Andrew, was Black Swan. I think, you know, and you've been to these conferences and people had put up a slide with Black Swan risk on it, and you just nodded it and acknowledged it, but didn't really think too much about it. Clearly, we'd seen it in the East with SARS, and they have an experience of it. I think now we've experienced it, but I think it leads into all sorts of other considerations as well in terms of operating models. You know, things like how, you know, business interruption insurance will become more mainstream in a way that, you know, frankly, terrorism cover did, a few years ago. Things like cancellation policies and what that all means, and just an acknowledgement that there's a new quantified risk out there, which frankly the West hadn't really seen or quantified in their models before. So I think, without being consistent, I think it's this realization that the black swan events do happen.
Thanks, Tim. Mariapia, what do you think will be the biggest effect of the pandemic?
A couple of things. One, I believe will be the transformational change in the product. A product which will go more towards digitalization, technology, and so forth. The second point, which is less operational, is about a change in the players. So I believe that some players which are active in the hotel industry, or not necessarily by choice, by ponderate choice, will kind of like shift their attention towards something else. More precisely, you know how much attention there is from the public sector in the hotel industry, and in particular REITs. I believe that the smaller REITs, the ones which have less liquidity, which have a higher exposure, higher loan to values, higher leverage, will in fact have lost confidence. In my opinion, lost confidence because probably won't be able to give their dividends. And I really think that for example, they will shift away from hotel investments. And so at the same time, while some disappears, others become more present. I also see some private equity investors, for example, buying more stakes in platforms in order to sustain liquidity. I also see some other platforms being created in order to increase demand, increasing efficiency, increasing access to distribution platforms and so forth. So if I had to say these two major changes, shifts in players and transformational change in the product.
Great, thank you. Merzak.
George, for me, and maybe this is just a little prediction, I'm not sure how scientific it is that demand could look different in a post-COVID world. And if that demand looks different, I believe that all hospitality companies, all hotel operators will need to reposition to capture whatever demand is there. That demand will be more demanding, more savvy, more knowledgeable, more evolving. And the holy grail for all of us owners, operators, or straightforward operators is to create downturn resilience. Remember, we've had a few shocks along the way in this sector. Amazingly, miraculously, we managed to weather the storm throughout the last, I don't know how many years. I've been in hospitality for nearly 30 years now. And you've seen terrorist attacks, all of that, and we've been resilient. This time it's scared people a lot. We've never had a situation where we needed to, or the industry needed to be completely shut down. So resilience needs to be built. To my mind, you can do this one of several ways. Probably the easiest one, I say easiest, most obvious one is to build resistance through business mix. That obviously will create more diversified route to market. And if you consider that one day the airlines could be impacted, if you take the view that we'll have another spike, heaven forbid, or this will be a cyclical thing, then your overseas visitors will not be there. Will the focus then be on domestic travel only? Is that enough to sustain us as a business? And if the answer is no, then we need to start thinking now what the future might look like in 2-3 years' time. I think diversification is key. Repositioning our businesses is key. Definitely a small example on that. For example, we never run any of our F&B businesses. We lease them out. The guys who run the F&B businesses, they were very good. During the lockdown, they reinvented themselves as upscale grocers. And believe it or not, George, they ended up making more money in some cases rather than less. They were selling high value goods in terms of fruit and veg, organic, wines with recipes, and doing a Zoom call with a chef of some sort, a fancy name. And people loved it. People in lockdown in apartments loved doing that. So we all need to think differently, I think, in the post-world environment.
Great. Thanks, Merzak. And thanks to you all for a really fascinating discussion. I just want to run through a couple of slides before we finish. The first is to tell you about next week's webinar, which is going to be a cracker, looking at co-living, which is a really exciting sector. This one is at 10 a.m. These are usually all at 2 p.m. This one's going to be at 10 a.m. because one of our contributors, Mindy from the Ascot, is at Singapore. And we thought it would be easier for her. So make sure you register for that. There will be a recording of this webinar emailed to everybody who has registered for it. And as I say, these sessions are all a precursor to the Urban Living Festival, which is taking place in London on November the 25th and the 26th at Tobacco Dock. And we have already got a strong cast of sponsors and supporting partners for the event. If you're interested in being a sponsor, then please get in touch with my colleague Katie, whose details are there. And I think we have a list of our upcoming, yeah, there you go. So there are the next few webinars. There's one every week in July, and then I think they're going fortnightly back in August, but they're all, they've all got great casts. They're all really interesting subjects. So I hope to see loads of you back here next week at 10 a.m. for the co-living one. It just leaves me to say thank you very much to Andrew, Tim, Mariapia and Merzak, and see you all next week. Thanks very much.
Thank you.
Thank you.
Thanks.